Good morning, everybody. I'm Gennaro Crocamo, and I work as a structured finance analyst here in Fasanara Capital. And along with me, we have Matkus, that is my colleague and friend, and is also the head of origination. And I'm glad to welcome you to the fourth episode of Fasanara Digital Dividend podcast, where we speak with founders and figureheads of market-leading platform in non-bank lending. So today I'm very happy to welcome two extremely accomplished founders of the newest addition to the Fasanara fintech family, that is Flexfin. So hello, Alex and Dimitris. It's great to have you here
Great to
today.
be here. Thank you.
Thanks for having us.
So before we jump into the details of Flexfin, how you build everything and all the nuances and technicalities, we know that both of you started the relationship, your friendship, very long time ago. Do you want to give us a bit of colors of how you met each other and how you kept your friendship up to the Goldman Sachs level?
We're friends from high school, and we keep bumping into each other. Alex studied in the US, I studied in the UK, but he came a year abroad, did the third year of university at the same university as me. Then we worked both Canary Wharf. Alex was UBS, I was at Citi, so always together even there. And then we both ended up at Goldman Sachs doing Greece at different covering Greece at different departments. I was in the fixed income department. Alex was in investment banking. So again, traveling together, seeing common clients, and we returned to Greece almost the same time. I returned back in 2012 to become an angel investor in the country. It was at the peak of the Greek crisis, let's say, the first one. And Alex returned a year later. So again, we were back in the country together, but not working together at the time.
That's super interesting that you managed to keep this relationship like for a long time, even after you, Dimitri, came back and Alex stayed here in London. So that many people could ask what was the decision that make you, go from Goldman to open your own business. Most of the people would keep on staying in Goldman. It's a well-known bank. So you decided to go on the harsh path of entrepreneurship, and that, of course, is full of troubles, but also full of satisfactions. And so, why did you decide to take that route?
I think in every job, the grass is green on the other side. You see other people doing nice things and say, okay, I want to do that. And then you don't realize how tough it is. So, it was a lot of airplanes back and forth almost every week. For me, it was a clear choice. I always wanted to come back to Greece. Because I was in the startup ecosystem as an investor, I saw all these fantastic things happening. And I knew I wanted to do something entrepreneurial. So it was, it was just looking around. I had a finance background, so fintech was kind of the obvious choice. And it was at a time where there's so many things to be done. There still are. So just at some point you have to take the leap and say, let's do something different now, because if you don't do it, then you'll never know what would have become. For me, it was an easy choice. I knew I was not going to be a banker forever, but Alex, I don't know.
Was it easy for Demetrius to get you to go and join?
No, so absolutely no. So the path was very different for me. I left Goldman because I wanted to do something on the buy side. I was on the sell side, and so we both had an intermediate step where Dimitri, as you said, he was an angel investor. I spent some time in effectively a small private equity looking at hotels in Greece, and that was kind of running its course. And Dimitri decided to start this business and told me about it. And in fact, in the beginning, I was quite negative on, I've already left Goldman to go to a smaller private equity, and then another jump to a startup felt like a step too far, to be honest. But after a while, in fact, something like 3 months, and I think having said no twice, eventually he convinced me. And obviously now,
I remember he asked me for time to think about it. It was like the whole summer or something. And then he comes back and says, no, absolutely not. So yeah, quite risk averse. I was on the other side.
But of course now, 5-6 years later, I'm very grateful that he insisted. So all good.
Well, of course, and I gotta say, for us, it's always interesting to hear the stories of how founding teams came together. Many times it's a relationship from a past job, but really knowing each other since high school, I think that's probably the furthest back we've seen any founding pair go together. And can I ask, does the relationship continue kind of outside of work? Do you guys go on vacations together, with your families? Do your families get along well together? Or is it now something where, man, I've been with this guy, I've known this guy forever, I'm done with him?
Can't stand him.
Yeah.
It's finally coming out on the podcast. Yeah, no, we do. We hang out outside of work as well. I think we try as well to take work away a little bit, but obviously, even when you're outside of work, it's difficult to get your mind off it completely. So we'll end up talking about it even on social occasions. But we do hang out a lot.
How did you manage to build the whole team? Now, I mean, Flexfin is growing, and of course, you're hiring a lot. So, how did you start convincing people to join this adventure, this startup, when it started at the very outset?
So for Flexfin, it was, as a business, quite tough the beginning because, I mean, there's an expression, we say in Greek, an ancient expression that the beginning is the half of everything, loosely translated. So getting started is the most difficult part, and for us means getting a license to actually be able to have our first customers. Getting a license means having the money, so convincing investors to give us a lot of money because we needed a lot of capital, plus convincing people to join us, to join a business that is not a business that doesn't have a license. And at the beginning, there wasn't not even an entity set up. So it was, if Alex was difficult to convince, the rest who were in front and didn't know us were even more difficult, especially because, we had to hire some bankers. As you said, they have a good job, well-paying job at a bank. For some people, doing that leap is a crazy thought of joining something that may never start, may never have revenue. So, it took a lot of convincing both employees and the shareholders, who had the big risk to, we had to hire people, set up the entity, go through a lot of expenses. We, had budgeted over $1 million to get us to the starting point, to having our first euro in revenue. So that's not a typical startup where you can just build a product, test it out with a customer, start getting some revenue, improve it. We just started with a PowerPoint presentation, going along and saying a very nice story in a very bad market. You always get all this thinking from both the employees and investors. Want the banks to do the same? Why you? Is there such a market out there? Which is the same thing I heard as an angel, and I actually asked as an angel investor, wouldn't Google do this? Wouldn't Amazon do this? Why don't they do it? And of course they could. Everyone could, but they don't. So somebody has to do it. And as I said, getting started is, you're halfway there already. So that's the most difficult part. And people come to you with ideas, and as an investor, they say, I have this great idea, but that is nothing. Once you start and you leave your job and, you have to depend on that, then it's something real, and then you can actually convince people to follow you, employees or investors or, customers. It's something real once you've fully dedicated to it.
And so, Demetrius, I think you touched on a point that is actually something that I think a lot of the people who watch our podcasts and listen to them, who are also kind of founders or want to be potentially founders in the fintech space, usually see as one of the highest hurdles. Or actually, you talk to two things that are usually the highest hurdles to clear. Number one, actually getting that first equity funding, and number two, something that many people don't have to deal with, especially in SME space, which is getting a license. Could you dive a bit more into kind of your approach that you took, and maybe the toughest conversations you had when you were trying to source that initial equity? Or was the initial equity kind of just brought kind of from your angel investing proceeds?
No, so our initial equity, we were looking for 10 million euros, which is a big amount, and Annex Ally didn't have that. So we, and it wasn't just the money because of the license part as well. It needed to be money from respected individuals. So if you cannot have like Bin Laden in your shareholder base, right? You wouldn't get a license. So we wanted a very clear shareholder base to have a higher chance to get a license. This in Greece, there hasn't been any other license in over 30 years, a similar license, and all the other licenses are owned by bank subsidiaries. So we had to not only find the money, which we had offers from certain individuals, but we wanted them to be able to apply to the Bank of Greece, and as soon as they look at it, say, okay, this is a serious effort, serious setup. You have a proper board, controls, and good shareholder base, and that what took us longer to get the funding. It wasn't just getting the a good idea and the money to get started. It was from who, and we vetted each and every one before we had it on board, and we ended up with 49 shareholders, which is also quite difficult to manage and not very typical for a startup. But after that we had 49 people, more people cheering for us.
But this is a very, very important point for you, because having such a barrier entrance in the market, it places you one of the strongest alternative lender in Greece. Because we're aware that there is a lot of struggle. You have to go through a lot to get the license. And how long did it take for you to get the license?
About a year.
It took about a year, which they told us, we had PwC as an advisor, that's the fastest they've seen in any sort of licensing process. Because, as I said, we had prepared everything very well from the beginning, and everything was super clear and in place, which, and there was a lot of bureaucracy, which, I'm sure every jurisdiction has that.
Yeah, exactly. So that places you already in the top scale of alternative lender, and that's one of the best reasons to go to Flexfin and to get partnership with you and to start a long-lasting partnership. But one thing that we were really happy to see when we came there for the due diligence is your approach on using the resources that you gather from your funders, from the equity funders. It was a very neat and meticulous approach. In the beginning, especially in the fintech space, we have seen an extremely growing market where fintechs start to hire a lot of people. They want to grow in size and they want to grow the book as fast as they can. But what we saw with you is that you were focusing on building the solid fundamentals, solid structure, without using the equity in a lavish way. So can you give some hints on people who want to start their fintech, how they have to manage their cash, especially in the beginning, because you might do a small mistake that could cost the whole company, but you managed extremely carefully your balance sheet and your resources. Can you give some hints?
So I would say, having seen all these startups run out of money, essentially, because a lot of startups have good product, good team members, just don't have enough time. We knew that the money would run out at some point, and it did, right? So although we had all this money in the bank, we're very, very careful with it, to the point, and we wanted speed, right? We wanted this license to come as soon as possible, and so when we had to, like, for example, when we found the office and we had to renovate it, the store told us, to send you all the toilets and the sinks and everything will take us, 3 days and 50 euros. And 3 days? No. Alex and I just went there and piled up the toilets in our cars and brought them here just to save time and money, although we had 10 million in the bank. So we were careful with every dollar from the beginning. Clearly, we did a lot of mistakes, but we didn't know there were mistakes at the time, and we threw some money away. But we tried to preserve this cash as long as possible, and we were right, because COVID happened, a lot of other things happened that were completely unexpected, and had we wasted more, we wouldn't be here today, I think.
And so how long was it actually? When did you complete kind of the first seed raise that got you this runway? And then kind of how many months of runway did that give you in the end?
So I guess the funding round closed in July 2018, and that was to 5 million to be exact. That, the runway is an interesting concept for us, because in terms of sort of annual operating expenses, that's, still covers us because it's a very high amount. However, because we use that cash to finance our clients and to provide lending, that cash effectively ran out through a combination of operating expenses that was obviously being burned and the lending that we gave out to our clients sometime at the end of 2021. And so that's when we started to borrow money. So I guess, as I say, it's difficult to put it in those terms just because that money goes out to clients. But I guess the cash that we raised from the beginning lasted for 3 years and a bit.
Well, I gotta say, I mean, it's music to my ears, coming from a kind of securitization and structured finance background, to hear someone who started with a balance sheet lending model day one. Because when you start with a balance sheet lending model, and we saw this reflected in kind of our DD of Flexfin and why we got comfortable with you, you have to start with a risk forward approach, because you're putting your money at risk. You're essentially putting your money on the line, and the skin in the game that everyone talks about, and some people offer up in the term of deferred fees, you actually had with your own equity at risk. Can I ask, was it a hard discussion with kind of your equity funders or people who came in at the early stages to say, hey, maybe you've seen in other markets, or you've seen on Sifted or AltFi that people are doing kind of balance sheet light, but we're actually going to lend this money out because we're confident enough in our underwriting and scoring that we're going to get it back and make a return on it? Was that at ever a difficult point?
So I think the issue in this market, in the Greek market, where we wanted to build a business, was that there is no choice. The only way to lend in Greece is to be a licensed balance sheet lender. There is no alternative. So I think the discussion was more, we want to do this and we think it's a great idea, and then there were questions around how great of an idea is it from our investors, as Dimitri said earlier. Is the market there? Because obviously, and I'm sure we'll talk about this, but our sort of proposition was that we will open up a market rather than take market share from existing lenders. So is the market there? Can you guys do it? Is it big enough? Can you get the funding? All these questions. So it was more that rather than, why are you not doing this, balance sheet light? Because there wasn't such an option.
That's super interesting to see, as Matt was mentioning, and we have gone through the part that was in the beginning, the starting phase, that is very, very hard, that has many challenges, but with a lot of work you went through, and you've been pretty successful so far. So what makes you different in terms of other alternative lender, and what's the competition that you have to face in the Greek market? Because we were mentioning before that there is this strong barrier at the entrance. So I believe the competition is not that big in Greece. So what makes you different toward other competitors, if any?
So I think, as you say, there's two different sort of sets of comparisons that you make. One is your market. So what's the competition in market? And I think there's a lot of differentiation in terms of sort of how we approach client experience. We're very client focused, and the way we approach risk and the way we use technology. I think in terms of comparison to other alternative lenders in other markets, because as we said, in Greece we're really the only one. I think the risk part of things, I think, is one of the main differentiators, because obviously independent lenders generally use technology and have client-centric approaches, but the way we approach risk is something that having done a little bit of research around the market, is also unique in that respect. And maybe just to expand on it a little bit, so when we look at our unique selling points, as it were, we always mention this one around risk approach. Our approach to factoring, or invoice financing, as we call it, has always been one to try to go to the pure sort of heart of factoring, which is you're financing a receivable. And therefore, if you do your job well, what you need to care about is the credit risk of that receivable. And when I say if you do your job well, obviously in factoring, there's a number of operational issues. Is the receivable really a receivable? Is there a credit note attached to it that you didn't know about? Was the goods, delivered properly, etc. So if you get that bit right and you do the operational diligence properly, then what you care about is that receivable being paid, the lender, the payer of that receivable being able to pay. And when we saw the market, we saw there's a number of these small companies that are not able to get financing even for very high quality receivables. And so our approach is, let's give those guys financing, because we know that we will get paid from a credit risk perspective from the high quality payers, and let's really do a good job making sure that the receivable that we think we're financing is the right receivable. And that's something that certainly is not done by the competition in market. So the banks do not look at factoring in the same way, but they really look at it as an extension of their lending products and do the same kind of assessment as they would for a working capital facility, which to us doesn't make too much sense. Or it does if you want to be super conservative, but it doesn't allow you to get the returns that you risk adjusted returns that you are able to get from this product. And even outside of the market, we see a lot of lenders that even independent lenders are doing, still doing quite a solid assessment of their clients, and focusing less on the receivables. But in those cases, many of them have receivables that are not as high quality as the ones we have. So, we've got this sort of, unbalanced approach where we have generally small clients, high quality receivables, and that we think is fairly unique even in other markets. And then the second bit obviously is technology. In order to handle a large volume of small invoices, etc., you need to do it as digitally as possible, and that's something that we've tried to do ourselves by building our own platform. We're definitely not where we want to be in terms of our ambition, but we're certainly better than anything else that exists in market, and we're building it every single day, improving it every single day, and hope that eventually we will get to the vision that we have.
No, exactly. So what we liked when we came over to Greece for the due diligence, we really liked the fact that you have a very strong automated IT infrastructure, and you run the day-to-day operation in a really automated way, and you're constantly developing that part, but you also keep on having like kind of close relationship to your clients, so that helps out for managing the relationship with them, and to ensure that that is also one of the major points why the credit quality of your book and that we assessed on our own, it's extremely good.
To piggyback on Gennaro's point, I think it is, as you highlighted, Alex. It's the utilization of technology to supplement a very prudent approach to credit that we saw, which shines through with Flexfin, and then also having that relationship element, that relationship management element that people, I think, are very used to with a bank relationship. And I'm curious to know if you consider yourselves kind of competing with banks, or if you see yourselves actually capturing some clients who might have previously been with banks in Greece, or if you really see yourselves addressing a market that banks, for one reason or another, again, potentially because of their size and not focusing on the receivable, just don't want to address.
I think it's by and large the latter. So we are addressing a market that really the banks are not addressing, at least in the product that we are in, the factoring space. So some of our clients may have some working capital facilities, or sort of very high, expensive corporate credit. But in terms of factoring, it's not a product that the banks are offering to the majority of the clients that we target. And the reasons for that are mostly size, and other sort of credit policy criteria. So the banks are unlikely to offer factoring to a startup, so a company that's less than 3 years old, a company that has a history of losses and not profitability, any company that isn't able to really bring 300,000, 500,000 a year at least of annual turnover in factoring to the bank, and a number of other criteria where where there's a shareholder who's not local and creates problems with legalization and things like that. That's not something that the banks are pursuing. And then on the other spectrum, also companies that may. So that's generally the smaller companies, and then on the other side, you've got some larger companies that are reperforming but have historically been sort of NPLs. So there, where you've got companies coming back into the market, obviously Greece went through a very large crisis that created issues for a number of corporates. They're also excluded from the banking system, and we find that for us, a company that's performing and has good quality receivables that we can finance should be financeable. So no, in most cases we don't see competition from the banks. In fact, I think from the total number of clients that we have, I'd say probably less than 5% have had or a historical factoring relationship with another bank, or have gotten a competing offer.
Wow. And I got to say, we couldn't have picked a better day to record our podcast on with that number in mind. So, today, June 27th, is International SME Day. And I want to highlight then that what I'm hearing loud and clear is that essentially Flexfin is acting as a clear champion of SMEs in the Greek market. And this is also something that aligns perfectly with Fasanara's overarching goal of helping support the SME economy, which is the backbone of the European economy. It employs the majority of people in Europe and generates the majority of GDP in European jurisdictions. And it's just, this is a story we hear time and time again, which is so sad, which is that banks, for one reason or another, usually because of operational constraints, they just won't give the time of day to someone who's smaller, even if they're selling to great clients and they have great receivables. And that's why we love partnerships with lenders like Flexfin, so much, because at the end of the day, you are supporting someone's neighbor, you're supporting their brother, their sister, and you're making the Greek economy flow. And we love being able to participate in that and help kind of with this long-term partnership. So really, very glad to hear again that you are funding these people who are generating super strong credit. We saw it in your loan book, we see it in the performance, and we will continue to see it. But on that note, I do want to ask, there must be some challenges in dealing with smaller borrowers, or maybe less sophisticated borrowers. And could you highlight maybe just a few of kind of the bigger challenges you might have had to face in your day-to-day with your main customer base now, and how you've gone about trying to clear those hurdles?
So first, we took the approach that we won't say no to anyone with a high quality receivable, even if they're because of size. So our smallest customer, I think to date, has been 1.8K, which of a loan, which I think which is unprofitable. Anyway you look at it. So we took that approach that we will say yes to everyone. It will they may introduce it to a larger client, they may grow. Eventually we may get that money back, but at this point in time it's unprofitable. So these smaller clients, a lot of them could be just single entity sole entrepreneurs, may not have any familiarity with the internet, are far away. They've always dealt with their bank and branch and have been used to signing stuff locally. So we are asking to do a lot of things that they've never done before. There's a lot of education in a lot of the cases to tell them, go on the internet, do this and that, sign electronically, all these things that sound difficult to them. And a lot of cases, it even sounds like, to a lot of them, we sound like fraudsters. This is too good to be true. Really, are you going to give me money? Why? Nobody else is giving me money. Why are you asking all these details? Why do you want my passport, my utility bill? And you have to go through all this process of explaining and trying to convince them that, we are what we are. So they don't have, a lot of them, don't have an account department. They probably have some external accountant that takes their invoices and logs them once a month. And we need those data to actually be able to to lend to him. So somehow they need to get to us. So it is more difficult to deal with them. They're not always profitable. But it's part of educating this new market, this new product. A lot of them actually didn't know the product. I didn't mention that. So because it wasn't offered to them in the past, they don't even know what factoring is, right? So we need to actually explain the product. And then one of the other difficulties is that because we're speaking to small customers and we want the receivables from their large customers, that is a very important relationship to them. They don't want us ruining that, or any chance of us, meddling with the biggest client, which would affect their business. So we had to. It was a big challenge to convince them to trust us, to speak to their client, manage the collection for them, do everything that we do, because they. We thought initially, we're offering money to people that have never been offered money before, so that's an easy sell, But it wasn't as easy as we thought, because we had to convince them that we are trustworthy and we won't ruin this relationship. So I think that was the most difficult part. And then, of course, once you go through that and they trust you, then the other bits of getting them online, teaching them how to use the platform and how to deal with us, is easier, but it's an easier step, but it can happen. But once they're on there, then it's easy to then sell them a lot of other stuff. So that's I think one of the USPs that we didn't mention earlier, because there's nobody else doing this. We think in the future we'll have a lot of things to offer them, and it's win-win for everyone.
I mean, and that's what is reflected in what you're saying is the biggest added value of the human relationship on top of the automation that you have in all IT infrastructure, is to let people understand through human interaction. We are here to help your company to grow your business and to give added value to your company. That's the beauty of it. So in this wider market, like in Greece that you are targeting, what do you see the market like? Is it a market that is affected by the increasing interest rate? How it is affected, and what's the current market challenges that you're seeing? Is it difficult to penetrate in this market, and what are the nuances that you see nowadays?
So I think in terms of sort of the macro picture and the general interest rates, in Greece is a little bit of an outlier with respect to the rest of Europe, and a little bit has always been. It seems to be a little bit counter-cyclical. When things were doing well, Greece was not doing so well, and now it's a little bit the opposite. So in terms of GDP growth, inflation, and general sort of macroeconomic environment, things are better here than they are in most other European countries. So inflation is lower by 1 or 2 percentage points than the European average. Growth is significantly higher in terms of GDP. We've had some good political stability, and very recently, a couple of days ago, that was confirmed by another general election which produced a stable government. We are expected to get back to investment grade in the next few months by at least some of the rating agencies. So the macro environment is strong, and we see that in terms of our clients. So we see, as Dimitri said, we have new clients that have now, even though we haven't been doing too much marketing in the last sort of 12 months, we see a lot of word of mouth clients coming to us and new business. But more importantly, to your question, to this particular question, we see our existing clients growing their business. So they're bringing us more what we call debtors. They're increasing the limits, or they're asking for increased limits for their existing debtors. So that's reflecting the general improvement in the economy and the growth in turnover. So we haven't, in fact, seen a big change or a change of trend that's coming from the interest rate increases. The general lending market in Greece has sort of stabilized a bit and plateaued, although without significant declines. The NPLs have not started hitting yet, at least on the banking side, and also not for us. And we see our clients continue to want to borrow. Many of our clients, especially because they're not seeing it as as a purely as a pure sort of loan that they're getting, but they see it as part of their sort of business. They see I can increase my business and I have to give up margin. And what's that margin? That margin was, let's say, on a 90-day invoice, 2 to 3% before, and now it's 2.5 to 3.5 for 3 to 4% because of the increase in rates. So, obviously it makes a difference, but for a business that has a 30-40% margin, which is where we are most relevant, that half or 1 percentage point will not stop you from doing business, because that means you're growing your book, you're growing your revenues, and therefore you're getting more profit margin. So far, it's really been fairly unaffected by the increase in rates, and we've had sort of fixed rates that were adjusted as interest rates were going up. We've switched part of our book and moving the rest of it to floating rates, as we speak, and clients have not. We haven't seen too much kickback.
Well, that's really, super interesting to hear in terms of the counter cyclicality, but also great to hear in terms of how you have seen macro markets kind of pan-European shifting, and you made the decision to shift your relationships and contracts over to floating rate to ensure that, kind of as a lending business, you remain competitive and are able to again provide an optimal offering to funding partners like ourselves. So I think that's sometimes a hard discussion that founders may have, or they worry that, hey, if I'm going to increase pricing to my borrowers, I'm going to lose business. But I think you hit the nail on the head, and you're obviously self-aware enough to see that you increased that price, but your customers had enough margin. They're continuing to grow their books, and they continue to grow with you. So that's really positive hearing that. I'm curious to know, because Dimitris actually made the point that for many of your borrowers, and even in the Greek market, factoring is still a new concept. So do you feel like in Greece that's going to continue to be kind of your focus on growth for the next year and kind of 5 years would be, educating the market about factoring availability to capture more market share? Or do you think there could be other shifts in directions of other products you may want to offer, or that people may be asking for?
So I guess we see factoring as the first step of Flexfin's sort of growth. So there's absolutely a gap. I mean, there's loads of gaps in the market, but this is an absolute gap that we've identified. We've already started plugging, and we feel there's a lot more room for us to continue to grow and increase the sort of the market itself, rather than try to get market share. When we were doing our initial sort of estimates of the market, when we were going out with presentations to potential equity providers a few years ago, we tried to estimate what the market is out there, and at the time, our sense was that there's pretty much another one of the existing factoring market out there that's just not being targeted and tapped. And so there is a lot of room for us to continue growing. And, as Gennaro has mentioned a couple of times, that, because the barriers to entry at the moment, there isn't too much else in terms of competition. Obviously, the banks may change their approach a little bit, but we don't see that happening in the near future. So yes, there's a lot of growth. And I think over the short-term period, so let's say 12 to 18 months, that's going to be our focus. We, as we said also from the beginning, we've always been very focused on profitability. And so we want to make sure that we hit that target as quickly as possible. And we think we can do that through the factoring product itself. But as we get all these clients who are not your typical demographic, everybody talks to us, and the first thing they think about is, okay, you're financing, 30-year-old startuppers who've created businesses. And in fact, the demographic that we have is quite the opposite. We have sort of 50 plus from sort of rural areas in Greece that you wouldn't normally think of as coming online and sort of especially managing this type of thing online, but they are doing it obviously because they have a need for liquidity. But that need for liquidity means that they're coming online, and the fact that they're coming online, as Dimitri mentioned earlier, means that we can then, we've passed the big hurdle. So selling them an insurance contract for their business, or a prepaid credit card, or FX through some sort of partnership with, I don't know, Wise, should be sort of straightforward. And so from our perspective, the next big step to our development is that creating a financing hub for these SMEs, to be able to cover not only factoring but a lot more of their needs, which they have and which they're not properly being serviced for, on a number of in a number of areas.
Can I just say this is music to my ears, hearing a lender who number one is focusing on building trust, number two has profitability first in every answer, and then number three is focusing on the product that they pitched us and that they pitched their investors, and that there is more room to grow to hit that addressable market size. And we couldn't agree more in terms of we see this growth path for you within the product you already have, addressing more of the market that you will be able to capture. But again, it is refreshing. And I think, again, a lot of the people who watch this podcast and listen to it are, again, younger people who want to start a business, or who are thinking about how they can maybe optimize their business. And it's again, these positive, maybe traditional thoughts of saying, hey, let's do one thing, let's do it right and do it the best before we start jumping to other things, and you're building up a valuable customer base. So again, just really, really positive. So kind of that leads into, I think, Gennaro's.
I just want to add a big one for us, which we've started looking at, but taking baby steps, is a product that our customers need even more than what we're giving them now, which is basically purchase order finance. So it's great that we give them money, they've delivered their product or their service, waiting to get paid, and they come to us and get paid up front. It's great. But what they would ideally like is to get the money sooner. So as soon as they get an order to deliver something, they have to import it, manufacture it, or whatever it is. That's when they really need the money to pay their suppliers. And again, their payable versus receivables are a terrible mix. The customers are large, and probably the suppliers are larger as well. So they have the worst of both worlds. So by doing this business the way we do it, we learn a lot from our clients without actually taking the credit risk of our clients. So we start collecting data about them, and when you see a customer growing, having more debtors, as Alex said, or having from the same debtor more demand, ask for more limits, then you realize that this company is doing well, because these companies don't always, probably the finances don't come out fast enough, whereas the data that we have are very fast and very reliable, or the sales data, and also we from that data we can infer a lot of our customers are doing before we get the financials. And a lot of times the financials, as I said, you cannot be trusted with this, especially the smaller the company, the probably less reliable they are. So we by harnessing this data, we can credit score our customers, and then we can offer them this purchasing order product that they need even more. But the key there is that we need to price it properly, and that's the holy grail. If we have enough data to give it to the people who can support it.
Yeah, that's absolutely true. So you're able to target the right people with the right pricing, and you're able to grow the book in a high quality fashion. But so we have heard until now a very successful story from a startup phase until the factory of millions book. So I'm sure there are many successful points, like many successful elements that happened through all this time. But what's the one that you are more proud of, like an element that you will always remember that you say, okay, here we understood that this is successful and we have to push even more.
We can give you each the chance to answer. So maybe if one of you can go first and say this is the biggest success of Flexfin today, and then we can see if they match. Maybe
You start.
I think just setting up a company by itself is I'm proud of that, right? We started out with a PowerPoint. Now there's a business. We have we started with 3 employees. I mean, Alex, me, and another one. So 3 of us, and now we're 24. You go out and people say, "Oh, Flexfin. Oh, yes, I've heard of you." That didn't used to happen at all. So I think just setting up this business, I'm proud of that as it is.
It is very nice when you see people that you don't know, but they know your company and they talk about that and they talk with a positive feedback. It's extremely good, and that's also one of the benefits of the word of mouth and doing a proper job. It's everybody will always talk good. But Alex, we want to hear your point on
No,
this.
look, I agree 100%. Walking into, and I'm in Athens, this office, and our Cyprus office, and just seeing a live business, and it's something that, we created from nothing. We started with a presentation and some crazy ideas, first the crazy ideas, then the presentation, and then you have a live business with knowing all the problems that you've had and challenges to get here. I think that's super satisfying, and I think it's something that only entrepreneurs really can understand. Before, and I don't know, maybe it might be the case for Dimitri, when I had friends doing startups, etc., and they were asking for investments, and I wasn't really an investor in startups, so I didn't really look at it. But I often looked at them and said, why are they going so slowly, and why have they caught their business plan and things like that. And now seeing it from this perspective, I really appreciate how difficult it is to get the idea, implement it, get the money, get everything, and continue to have everything going. So I definitely agree that's the thing we're most proud of. And of course, the funding facility with Fasanara. Let's not forget that.
There we go. Yeah, right answer. No, but it's a beautiful sentiment, and again, it's echoing kind of the spirit of entrepreneurship, and that's again something we just love to support and be a part of so much. We love finding passionate founders who really, again, take this approach to building up a business that prudently, that they care about. And I think that kind of leads us really well into kind of the last segment, and then we'll let you get back to building that book up, which is, I always like to ask people who I kind of admire and consider very good at their jobs, and kind of what one single lesson they would want to communicate to someone else would be. And in this case, one single lesson to someone else who wants to either enter or start a lending business could be. And so maybe this time we'll maybe we'll reverse the roles here. So Alex, you get to go first this time.
One single lesson. It's difficult to pinpoint one. There's quite a few things that we've learned over the years. I would say I think it goes for a lending business or any type of business. I think when you've decided something, you should, and so you decided to go for creating a business. I think you should be as sort of desperate as possible on the daily sort of grind. So don't let things slip. This is something that you need to be on top of everything all the time. And obviously everybody needs a good, balance in life. And I'm absolutely not saying that one should work all the time, but there shouldn't be, I think your everyday move should be, I need to do this now, not because something is going well. You just, put your foot off the pedal and don't call somebody, don't push somebody to get something done. I would say, because I think when you do that, you sort of lose out on things. And I think you should continue to stay focused and work like everything is super important. I think that'll get you to your next or to get you to your goals.
Okay, very very inspiring and deep there. Demetrius, do you?
For me,
What would be your one lesson?
mine is not so inspiring. I think I would say that if you can do a business and you have a choice, regulated or non-regulated, go for the non-regulated bit, because the regulation. Yeah, I didn't expect the regulation to be so much of to take so much of our time, personal time. So it's all there. They tell you everything at the beginning. Looks simple. You write up your policies, put up your procedures, and it's not. At first, it keeps changing, but also it just it defocuses you from the business, and you cannot disregard it. You have to do everything. So for me, if you start a regulated business, you have to understand what it entails first before you're going, because that I didn't have this sense when we started.
Well, that is extremely, extremely powerful, I think, because that is a choice that many, many people face in their specific markets, and that can influence, the business model set up from day one. It can influence if they use third parties or try to passport licenses, work with fronting partners. So again, very, very helpful and powerful, meaningful words from both of you. We really appreciate it. So, Gennaro, what do you?
Yeah, I mean, I just first of all want to say that this has been like a great conversation to see how you start everything. Like everything started from a good friendship, and then it became a success story, not just from a friendship perspective, but also from a business perspective. So where people can actually fund you, like if they wanted to factor their invoices or they want to just have some inspirational hints on how to build their own business, can you give us some details where people can find you?
So best bet is our website. So www.flexfin.eu. We are actually in the process of relaunching that. So in the next month or so, it will be a new one. But all the information is there. We're easily contactable through that, and happy to obviously get new clients, but also happy to share our experience with anybody. And for anything, we're very much of the approach and the view that there's not much reason to hide things. We've never been secretive about our business. We're very open for any question that anybody wants to ask, and we're also very much of the view that it's good to meet people even if there's not something immediate to get done now, because at some point in the future there may be. So we anybody should feel free to get in touch.
And we're both on LinkedIn, so you can just message us there as well if you want something more personal.
Perfect. Well, thank you so much, gentlemen. We really appreciate your time. It was always great talking with you both. I very much looking forward to coming for the next screening and due diligence, because I have to get some more of that delicious Greek food
and the beautiful view of the
Acropolis. Oh my gosh, mind blowing. But thank you so much.
We very much look forward to having you, and maybe just to say one thing to listeners.
Yeah.
We've obviously we've recently closed the facility with you guys, but I have to say that in terms of the approach that Fasanara has taken towards us, we've been extremely happy as the way that the approach and investment and the way they treat, or you guys treat your borrowers, I think has been very much a partnership basis, rather than some approaches that you get from investors that I'm the investor and let's just do what I want. And so we've appreciated that very much, and we're very much looking forward to developing this partnership.
Yeah. This was at the end of the podcast. He didn't have to say all these things, so it's actually true.
Well, thank you very much. Thank you, Alex.
We really appreciate it.
That's really nice. Thank you so much, gentlemen. Have a good afternoon.
Have a good day. Bye-bye.